and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guests for today are Jack Large, editor of CTMfile, and Paul Galloway, senior advisor at Strategic Treasurer. Welcome to the Open Treasury podcast, Jack and Paul. Gentlemen, this week we are focusing on 8 stories that cover 4 themes. We'll discuss currency, namely the impact of the strong US dollar on corporate earnings and venture capital investments in cryptocurrency. Central banks and treasury, that includes Fed's recent interest rate hike, supply chains bolstering, and privatization of public sector banks in India. Cash and liquidity management, encompassing the 2022 Working Capital Survey, and finally the payment section that will cover swift cross-border payment challenges and digital transformation of global payments. You can look up these news articles on CTMfile or by the links in our show notes. Let's begin our discussion with the first section that revolves around currency. Corporations are facing myriad challenges: supply chain snarls, the Russia-Ukraine war, the global energy crisis, China's economic slowdown, inflation, interest rate hikes, and now another growing threat: a strong US dollar. Jack, if I may start with you, if you were a treasurer for a US multinational corporation or for any global corporation, what would you be most concerned about when you hear that the meteoric ascent of the US dollar has wiped billions of dollars off the second quarter sales of US companies? Also, would you review your hedging strategies in the light of the surging dollar?
The answer to your last question is yes, of course you'd need to review the hedging strategies, but this has already been done by all the corporates, that are large corporates I know. The issue is how to manage the transformation back to normal. At the moment we've got the euro under $1, which is amazing, and you're seeing corporate treasurers wondering how on earth they can manage the individual flows of trade that they've got. The issue, I think, is this is going to go on for a long time. This isn't a single month. This is going to be at least a year, in my opinion. And so the strategies need to cater for that and be able to encompass all the different pieces in the supply chains. This is not going to be easy.
Paul, would love your opinion.
Totally agree with it. What Jack is saying. I mean, this has presented a lot of new issues for corporate treasurers, and no doubt, corporates most of them are already engaged in their hedging programs or actively managing those. Certainly the timing of when the flip happens back to normalcy is something that hopefully corporate treasurers are keeping an eye on so that they can manage a smooth transition versus something that flips hard and hits the bottom line when that transition happens. So, I think there's a lot of considerations for corporate treasurers today. Obviously, some companies have a lot more exposure internationally and outside the US than others. It doesn't mean that corporate treasurers that have a higher percentage of domestic-based business shouldn't be concerned about what the strong dollar is doing and when it starts to weaken.
Yeah, one of the impacts of the strong dollar is that it makes, by definition, if you're a US exporter, your products more expensive. But it also impacts the other way. When do you work out how to hedge for when it does decline? It's a non-simple problem.
a non-simple problem. Moving forward, venture capitalists continue to invest in digital currency and blockchain startups at a rate that is set to surpass 2021's record, despite the uncertainties in the cryptocurrency space, even as the total market value of cryptocurrencies has fallen by almost 2/3 to US $1 trillion. Bitcoin may have just capped its worst quarter in more than 10 years, but venture capital doesn't care. And private money is piling into crypto at a historic breakneck pace. Jack, why do you think crypto VCs, the die-hard breed of crypto enthusiasts, are continuing their spending spree in the beaten-down crypto asset space?
I'm not sure it is increasing at the rate you're talking about. Okay, that's the historic rate, but if you look forward, we've had things like the Terra USD just wiped out billions of value, and the Guardian put it very nicely that investors who are typically also into normal stocks and shares are now working out how to change the balance, because the impact of the huge changes in the cryptocurrencies means that we're starting to see some very worried faces. The other thing I'd like to point out is that we're now starting to talk about crypto as a currency, not a token, but a currency, something that people invest in, not treasurers at the moment is my experience, but other investors are now considering that in their foreign exchange portfolio, cryptocurrencies is now part of that, which is a major change.
What would your opinion be on this particular development, Paul?
Yeah, I think crypto, is a pretty interesting space. You had asked me several years ago. I'd take the Warren Buffett approach and say, I really don't know much about this. I don't know why I would invest in it. I don't see it as an investment. Right. Today, I think things are changing, and the market in general has been getting pounded. When I think about what's happened, what's transpired, there's a lot of factors that go into that, but this space is relatively unripe, I should say. It's relatively new, and so it's continuing to evolve, and I think there's a lot of things that still have to happen before crypto is truly accepted as a currency. But you can see it's heading that direction. Corporates are already planning and making plans to invest in crypto. I'm aware of companies that are putting together brand new legal entities that will house an investment in crypto. And so that tells me that it's becoming more and more accepted that, hey, this is a currency. People are willing to trade it for goods and services, which means that there's going to be more infrastructure, more opportunity, especially on the fintech side, to grab a chunk of a business or a platform where you can get value or derive value out of a platform or an infrastructure to support this. So I think there's a lot of opportunity in this space. Doesn't mean there isn't bumps along the road, though.
Fraud is still a major problem, and it seems to me that there still isn't enough regulation around the cryptocurrencies to make normal investors feel comfortable, and I think that's going to continue for a while. But once you get rid of the worries about, or reduce significantly the worries about fraud, then I think not only venture capitalists but ordinary investors will put into this market in a big way.
Both of you made some great points, and moving from crypto to our next section revolves around central banks and Treasury. Last week, the US Federal Reserve, or the Fed, hiked interest rates by 0.75 percentage points to combat inflation. While the Fed funds rate feeds into a multitude of consumer products such as adjustable mortgages, auto loans, and credit cards, it also impacts corporate borrowing costs and business activity. My question to you, Paul, is that do you think higher interest costs and less business could mean lower revenue and earnings for corporations, potentially impacting their expanded investments, growth rate, and their stock values?
I think there's probably a temporary hit that's going to happen as we continue to see rates rise. What we all have been guilty of over the past 10 plus years is that easy money has been available, and when you have easy money for an extended period of time, we get fixated on these low rates, and these low rates haven't been the normal reality is that you do have some costs associated with capital funding and liquidity, and now corporations aren't going to be able to take advantage of the low interest rates that we had. We will continue to see Fed rate hikes. We will continue to see pressure on rates going up. This will have an impact on banks and decision making to fund something or not fund something. But at some point, companies are going to say, well, if I sit here and do nothing, then I have no opportunity to take advantage of leverage, which is cheaper than equity capital, or capital derived from the business itself. So if I want to continue to deliver value to my investors, I'm going to have to lever up. I'm going to have to take advantage of what's available out there on the balance sheet to fund investments in new products, new entities, or other things that will help drive value back to our investors. So I think that will be temporary, and then we'll kind of level out, and corporations will get back to doing what they do best, which is raise capital and make investments for the future.
Jack, do you share a similar opinion?
I think you need to look at it the other way round. This is driven by central banks across the world only having one mechanism to really control inflation, because they've all been given the job of trying to control inflation, which our next piece of discussion will discuss in more detail. But this reality is just, it's unescapable. I agree with Paul that we have to make investments. The era of low cost liquidity is just finished. I think this is one of the biggest conclusions here is the low cost liquidity era is finished and isn't going to be around for quite a while. Then the realities of existing continue.
So moving on from one challenge, inflation, to supply chain resilience, U.S. Treasury Secretary Janet Yellen has reiterated her appeal for the United States and its trusted trading partners to boost supply chain resilience through friendshoring. The term friendshoring draws on the concepts of onshoring and nearshoring, which refer to the transferring of supply chains back home or closer to home as opposed to having them in foreign countries. Friendshoring goes beyond that, but limits supply chain networks to allies and friendly countries. Jack, do you think in the light of the US Treasury Secretary's repeated appeal, more corporations will reshore, nearshore, or friendshore their supply chains and move toward closer or shorter supply chains so that they are less prone to trade and geopolitical disruptions, even if there is some cost to bear?
I think it's inevitable. I mean, Apple has already started doing it on quite a scale, not a big scale, but the other thing is that the global pressure to avoid tax tricks, so you only do business in certain countries because of the tax, I think that advantage is going to disappear. So the onshoring, or friendly shoring as Yellen calls it, is going to happen, and it's going to happen in a big way.
Paul, would love your thoughts on this.
Yeah, I think this is, definitely something that that U.S.-based companies are faced with today, especially in light of the supply chain disruptions from COVID, the invasion in Ukraine, rising tensions with China. There's a lot of factors that are going into it. I think companies are rethinking supply chains, and quite frankly, I think they need to. The other piece that's going to come into play is how can they make the economics work? And I think they'll figure that piece out along the way. And I think there's opportunity. If I'm a U.S.-based company, I think there's plenty of opportunity in the Americas to redirect supply chain. It's going to be interesting to see what happens over the next several years and how this all plays out. But I definitely think this is something that's it's a trend.
The other piece of this local manufacturing is that actually the climate change impact is much less. If you produce locally and use it locally, the global climate change impact is so much less. That's going to be another major pressure.
Another major pressure, climate change. Our last story in this section that merits discussion is about the debate heating up on privatizing India's public sector banks, also referred to as PSBs. A recently published policy paper, Privatization of Public Sector Banks in India, Why, How and How Far, authored by economist Arvind Panagria, former vice chairman of India's government think tank Niti Aayog, and the National Council of Applied Economic Research Director General Poonam Gupta, makes the case for a major drive to privatize India's public sector banks. Jack, what is your opinion about privatizing India's public sector banks? Do you think it is good news for Indian corporates if it were to happen?
I don't know. I really don't know. Some of the private sector banks are very successful, others are not so. The issue for me is, and I get it from corporate treasurers asking me, well, who is the local bank I need to use in India that gets good coverage? And there is not agreement on that at all. I think that's where the problem is, not the privatization.
Paul, any thoughts on this subject?
This is interesting to me, just thinking about, how would something like this work in the U.S.? I mean, it's just very interesting. Granted, India's banking system not the same as the U.S., and I think it's to Jack's point, there are some banks that I think on the public side do quite well, and others that don't. I know from prior experience there has been a debate around who is a good banking partner in India, and that is something that is just not clear cut to me. And I'm not close enough to the banks there, but I know that is a question that's been asked at other organizations I work for or worked on behalf of, and it's not an easy nut to crack. Given that the proposal that's out there, I think I would like to learn more about how can this privatization fuel higher overall growth within India, and that's what's not clear to me.
The third section up for discussion pertains to cash and liquidity management. The story that we chose for discussion in this section is to help us determine a clearer picture of whether companies would be able to access adequate working capital to run their business for the next 12 months. According to the recent C2FO 2022 Working Capital Survey report that was conducted by Morning Consult and includes responses from 1,240 business leaders in 10 countries, a combination of forces, including soaring inflation and rising interest rates, could make it harder for companies to access the funding or secure capital they need to survive and grow. My question to you, Paul, is given the prevailing economic uncertainty worldwide, do you think liquidity challenges are on the horizon and companies need to prepare for tighter liquidity?
Absolutely. That's definitely my answer to that question. I think corporations would benefit by positioning themselves today for what could transpire over the next 12 plus months. If companies didn't start last year, I think they're already behind the eight ball. And I can tell you from experience, last year I started looking on behalf of a company I was working at. I started looking at opportunities to prepare the balance sheet for things that were coming. And so we were looking at multiple types of different funding structures that would be in play. Some were, had optionality. Some were more contingent liquidity facilities. And these are the kinds of things that corporate treasurers, if they aren't already thinking about them, they need to get up to speed quickly.
Jack, what are your thoughts on the subject?
Just to repeat what we said before, the low interest environment has gone, and it's going to get worse for many months, if not years. It will be combined with tighter liquidity, like banks will not be able or won't encourage a lot of borrowing. I think this is going to be a very tight year for liquidity and interest rate management. It's not going to get any easier by any specific thing that corporates can do. Obviously, they need to check with their liquidity and borrowing limits in each of their banks, but it's also whether the banks can actually cope with the pressures. And that would be one of my questions is, can your banks cope with giving you any more liquidity? Where are your alternatives? Because it's going to be tough.
Where are the alternatives? And it's going to be tough. Well, a lot of challenges for corporates, and one of them being liquidity. Moving on, the fourth section that merits discussion is about payments. A paper from the Economist Intelligence Unit, or the EIU, predicts that the Russian invasion of Ukraine will cause disruption to cross-border payment systems and could, in conjunction with technological advances, challenge the dominance of the SWIFT network. SWIFT, the paper notes, has encountered criticism for its relative inflexibility and lack of transparency, and seen a decline in the number of correspondent banking relationships over the last decade. Cross-border payments is also being disrupted by government-backed efforts to link payment systems. In Asia, moves are already underway to do this, allowing travelers across the region to purchase goods and services by scanning QR codes. China and India are doubling down on their nascent SWIFT alternatives. My question to you, Jack, is that given the prevalence of dollar-denominated cross-border flows, will SWIFT remain the dominant network as long as countries and lenders come together to improve the Belgian network?
Yes, and yes for a long time. The infrastructure required to model or compete with SWIFT it's going to take years to develop. And you have to remember MasterCard and Visa, who have a global network, still haven't managed to have much impact on SWIFT's dominance. Having said that, you are going to see regional hubs where you see various banks in a region combining. So you're getting Singapore combining with other countries, and you see the same in Nordic region where a real-time payment can be made in 5 countries on the same system, even though they don't have a full interbank system. There are going to be areas where the banks will carve out new niches. But before I forget, the Volante paper is one of the best papers I've seen on global payments for a long time. I'd highly recommend it. It's in the report, but it's highly worth reading.
Wonderful, and in a minute we will discuss that too. Paul, would you concur with Jack's opinion on SWIFT, or do you think otherwise?
I think Jack's right. I mean, look, Swift's platform, the infrastructure is massive. The connections to Visa, MasterCard, and a lot of folks that are using them or have them integrated into their payment systems today, whether it's ERPs, admin systems, or treasury management platforms, or something else of that nature. You know, it's very integrated into the payment system broadly, which means that it's got some staying power. But what is probably more interesting to think about is, when does SWIFT step back and say, hey, maybe we need to make some changes to what we're doing, given how the landscape is developing? Because payments as they are today, they're not going to be the same 10 years from now. It's going to be, completely different. And you're starting to see, this particular article had a great depiction of what's going on in Asia. And, they're actively changing things. And if SWIFT is inflexible and not able to change along with everything else, they'll end up getting left behind. And so that won't be something that's anything immediate, but that could happen. And we've seen that happen with all kinds of different things over years, whether it's typewriter to computer, and dial phone to cell phone. I mean, there's lots of things that disrupt and take over. So you can't always just be stiff and rigid in what you're doing. So what SWIFT does next will be pretty telling.
SWIFT is being much more flexible than it used to be. Their adoption of ISO 20022 standard opens a new door to a whole range of services. I think the issue is whether they are going to be able to get into the retail space, the consumer to business space, which is dominated by Visa, MasterCard, and by the local payment systems. We'll see, but I think there's some initiatives going on inside SWIFT which we've not seen yet, but will make it a lot easier.
And we will be monitoring and watching the SWIFT story very closely. Moving forward, the last story in this section is about the 4 pillars for payments modernization and the digital transformation of the global payments landscape. With the winds of change blowing rapidly through the payments landscape, Volante Technologies has produced a white paper, Global Payments Planning for the Next Decade, that examines key markets comprising Europe, the United States, South Africa, Middle East, and Latin America that are undergoing radical digital payments transformation. The white paper identifies major trends and developments of interest and benefit to corporations, banks, and financial institutions, and also broadly summarizes the 4 pillars for payments modernization, namely real-time payments, interoperability, ISO 20022, and technology. Markets worldwide are experiencing unprecedented digital payments transformation, and payments modernization is happening faster than was previously expected. Jack, if I may ask you first, my question to you is that upon examining the report and the key markets that are undergoing unprecedented digital payments transformation, do you believe that it augurs well for real-time payments, for payments messaging, liquidity management, cross-border transactions, and cash visibility?
Oh yes, the world's going to be perfect. No, it's not. The issue is going to be the integration of the different initiatives. And that's where Volanti, as a supplier of banking, payment services and linking, is going to be key. I think some of the concepts in that report are very important. You talk about real-time payments, but what we're starting to get to is that everything in some way is real-time, and it's just when you report on it. And I think the distinction between real-time and ordinary payments is going to disappear, and that's going to affect all sorts of different things, from the local systems to the cross-border payment systems. We're not going to accept anymore 3 days before we get the money. That isn't going to work. Customers are going to migrate to what's ever easier. Digitization is definitely coming. I'm looking forward to it.
Looking forward to it. Paul, are you looking forward to it too? And what were your thoughts about the report?
You know, as a corporate treasurer, I welcome real-time instant payments. Why? Because if I can eliminate negative float, that's what I want to do. I want to get to the point that I can manage. If I can manage my bank accounts down to the penny, and be able to hold only what I absolutely need, and be able to receive payments instantaneously, I'm going to be a happy guy. You know, there's a lot of companies today that, as Jack pointed out, you know, they're waiting 2-3 days to get payments. And to me, that's, in today's world, that's just ridiculous. There's no need for that anymore. It's going to change everything. You know, trading times are going to be completely changed. Every type of vendor payment, the way you manage working capital is going to change. Everything's going to change. And I think it's going to be a positive change from my perspective. So I definitely welcome that.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or most important story of the past week and why. Jack, if I could start with you.
The most important story for me is what we're seeing here is the global stress the economy is under worldwide, and it's coming in different ways. So we're getting interest rate increases by central banks, we're getting inflation. The thing that comes out of this, though, is that the role of banks is going to become more critical for corporates than ever before. They're going to have to find out who's going to look after them, who's going to grow with them. That, for me, is the biggest issue and the question coming out of this last week.
Paul, what would you reckon as your most important story of the past week and why?
Well, if you're reading the headlines on Bloomberg, it's Pelosi going to Taiwan. But you know, I think what's interesting is you know, we had some recent indicators come through. You know, obviously inflation a few weeks ago, we hit that 9.1% number. The Fed just raised rates 75 basis points, but employment is still very strong in the U.S. And we're also seeing companies are beating, you know, estimated forecasts. So, yeah, we had 2, you know, quarters of negative GDP, but there's some factors tied to inflation and the other things that are going on are driving that. But some of the underlying fundamentals are still really good. I'm going to continue to keep my eye, and I always keep my eye on this. You know, what's going on with employment? Are people working? Are jobs available? Are companies still fighting for employees? And are consumers spending? And we're kind of seeing all that happening right now, which is good. So we'll see what happens over the next, you know, 5-6 months and leading into 2023. We got midterm elections coming up, so we'll see if there's some policy changes that may happen. Who knows? There's lots of things going on, but those are the things that I'm looking at.
That was an informative and insightful analysis. A big thank you to you, Jack and Paul. and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you so much. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.